Welcome, everybody, and good morning. Thank you for joining us on today's Barron Opportunity Fund and High Growth Strategy webinar with Portfolio Manager Mike Lippert. My name is Bill Zorovich, and I'm a member of the intermediary sales team at Barron Capital. Just a little housekeeping note before we start. If you have any questions, there's a question and answer box at the bottom of your screen on your control panel. Please type them into that panel, and I will address them with Mike as we go along. Mike is the portfolio manager of the Barron Opportunity Fund and the Barron High Growth Strategy. He is also our head of technology research here at Barron. He has 22 years of investment experience, 21 of them here at Barron, and research experience. For the last 16 years, he has been the portfolio manager of the Barron Opportunity Fund. He took it over in 2006. Morningstar, even though we put it as a all cap growth fund, Morningstar places it in the large cap growth category. Without any further ado, I would like to welcome Mike, and thank you for joining us today.
Thank you, Bill, and thank you for everyone who's tuning in and gonna do this on recording.
Yeah, okay. The entire year of 2022, and even, it started in November of 2021. And the fourth quarter, it just concluded, proved to be dominated by macroeconomics. There was overlays of geopolitics, including the war in Ukraine, U.S. midterm elections, and the China COVID zero policy. It was less about business fundamentals or secular growth trends. It proved to be a bleak environment for the fund. It was a tough year in the fund, as you know, as well as the broad market in general. I mean, I like to say there was nowhere to hide last year. Maybe you could, take us through your thoughts of what you saw last year and what you see going into this year. And you, one last comment in your quarterly. I was lucky enough, you kind of passed it on, and you continue in the same way, talking about macroeconomics, which you never really talked about as much in prior years, but we really, this past year, you talked about it quite a bit. Why don't we start there?
Yeah, thank you, Bill. And I'm going to try to touch on this at a high level. If anybody wants to go deeper, please, ask questions for us. Don't want to be around the bush. 22 was a very tough year, very, very challenging year for the portfolio. Since I've been a portfolio manager, it was second worst year for the fund. The only worst year was 2008, the so-called great financial crisis. Bill, the reason I talked about macro is because last year was dominated by macro. It wasn't dominated by fundamentals, certainly not long-term secular growth trends. So what happened? Everything digital had incredible tailwinds during the terrible period of the pandemic because our world had to get digital. And so companies accelerated. No one knew what it was going to be like when we got to the new normal, and certainly stock prices performed very, very well and valuations got very high. I'm not going to call it reversion to the mean because we reverted below the long-term means, but last year was a reversion year. You were met with high valuations and almost a perfect storm of the Fed for the first time in many, many years, raising interest rates sharply, 425 basis points in 1 year, which is either a record or close to a record. You have to go back to the early 1970s to have anything like that. On top of that, certainly, the big geopolitical event to start the year was, of course, the war in Ukraine, which nobody expected. And so the markets in all pulled back significantly. Certainly the tech sectors pulled back significantly. Growth significantly outperformed value. These statistics will be in the quarterly letter when people receive it, but 100% of the pullback in 2022 was due to multiple compression, mostly because of rates. Certainly, of course, there was an element of that, of people's view of the forward economy and forward numbers, but mostly rates. When you think where we are today, rates peaked in October, the market bottomed in October. Certainly, sectors that we accentuate, software and semis, have done that, have performed better. If anyone asks me, are we at the bottom? Is at the bottom? The truth is, I don't know. But we've come back so much. I had a conversation with one colleague, and he half joked about the recession that, for, the sectors that we emphasize, we've been in a recession for almost a year, both in terms of the multiples having come down significantly, as well as numbers pulling back. And where we sit today, understanding that 2023 may be a challenging year with a lot of macro headwinds, but all of the secular trends that we invest in are intact. We are favoring companies that we think will be more resilient to the macro headwinds, will accelerate when we come out of this economic period, and certainly have great long-term secular growth characteristics of their business, and are not now trading at valuations where we can make very, very solid returns for the long term. The one thing I want to say, everyone always asks about interest rate. Yep, we've taken into account a higher level of interest rates in how we do valuation. I've talked on these webinars and I've written in my quarterly letters that the way we think about valuation is what we call the long-term median or average multiples. In all candor, given the year that we're in, we're using multiples at the lower end of what we consider to be average on an absolute and growth adjusted basis, and still able to achieve, very, very positive returns. And by that, I mean long-term returns, 15 to 20%, if not higher, for the bulk of our portfolio. So let me stop there, Bill, and please, any follow-ups.
So we joked as we were preparing for this, and you talked about it at our conference this year. In your best reference of Yellowstone, you talked about trimming the herd. And kind of culling it down. So some of the things you did last year to that we do in a normal, it was a tough year, know more about your companies, maybe less companies. What are some of the things you did last year?
Yeah, so in essence, what I mean by trimming the herd is we focused the portfolio. So we came in the year, the exact numbers, maybe 60 or a little bit over 60 when we entered 2022. We exited 22 with roughly 45 individual companies. There are a few companies we own multiple securities in. At the low, we got down to just above 40. At the end of the year, there were a couple of companies that we added. And so we were doing that to concentrate the portfolio in the names that we had the most confidence in. Again, the combination of things that I talked about, all the Barron qualitative factors, big growth opportunity, particularly competitive advantages, the management team, and then the numerical or quantitative factors, how we think a company will get through an economic downturn, what we think the long-term growth will be, and certainly the valuations. And we're trying to have the best balance of all of those factors expressed in the portfolio. I mean, one area we added to significantly is semiconductor. So if you go back a year, our most significant semiconductor investment was NVIDIA, which is taking advantage of cloud computing and artificial intelligence, which I'm sure we'll talk about. Semiconductor stocks, we believe, have great secular growth trends around those things: cloud computing, artificial intelligence, what is called the Internet of Things. And one of those things will be your car with a lot more chips in them, particularly EVs. Stocks traded down, and we use that opportunity to significantly add to our portfolio. Semiconductors are now over 10% of the portfolio. Again, do we know that we hit the bottom? We don't, but we think, we added to stocks at attractive levels for long-term investors. Could we retest? We certainly can. Could we look back and say we did great trading? We certainly can, but none of our aim, I want everyone to understand this, we try to do smart and pragmatic trading, but we're not trying to be great traders. We're trying to be great long-term investors. And so when stocks come into what I've called the buy zone and marry up with our qualitative research, that's when we might add to a given stock or an industry like semiconductors.
You did in this quarterly letter, as you've done in the past, and you included a list of transformative digital type companies and then you looked at more consumer staple companies and put some cash flow and nobody has seen it, but we've said that nothing is trading on fundamentals. It's not about it just seems like the companies are doing better fundamentally wise than the stock price is doing. And you talked about multiple compression. Comment. I mean, I like that you put it back in your letter this time, and people will see it when it finally hits our website. Maybe you can comment about the chart you put on there.
Yeah, so we're always asked questions about, is this a good buying opportunity? And I was just on a recent conference call with an investor, and I was asked the typical value growth question. And so I addressed it in the quarterly letter. The table that I put in is something that I monitor, and it is something I've put in the letter before, and it is what I call select digital transformation leaders, all of them owned in the portfolio, names like Microsoft, Amazon, NVIDIA, Tesla, ASML, I won't list all, against a group of what I call large cap consumer staples or less discretionary. Names in there are the common ones: Procter & Gamble, Coke, Pepsi, Nike, Starbucks, Mondelez. Again, these are street numbers. These are not our numbers. So this is where Wall Street is today, based on FactSet. Wall Street could be wrong. And what you have looking at 2024 on an enterprise to free cash flow basis, you have the digital transformation leaders trading at 24 times, and you have the staples trading at 29 times. That's pretty interesting. Let's think about growth. Digital transformation leaders, 17% revenue growth, 25% free cash flow growth, and that's excluding Amazon, which people expect to double. I excluded as an outlier, to be fair. And the staples, of course, lower growth, 6% on the revenue side and 12% on the free cash flow side. And then the efficiency of the business models. The free cash flow margin for the digital transformation leaders, including a lower level for a business like Amazon, which is only 7%, but the average is 25%, again, for the digital transformation guys. The average for the staples and less discretionary leaders is 14%. So you have higher growth, more efficient business models, trading at a lower multiple on EV to free cash flow. Of course, I accept people can look at PE multiples, they can look at EV to EBITDA multiples. So this is just one look. The other thing, I mean, value significantly by over 20 points outperform growth last year, particularly on the large cap end. So again, I talked about reversion, below the median, but if you think about reversion to the median, certainly over the next couple of years, I think growth is well set up. And the last thing I'll say is, when you think about the market, I've tried to simplify this a few times in the quarterly letters. What do you need for stocks or groups of stocks, so-called indices, to have good returns? You need expansion of the E, because the multiple, the PE, will go up and down over time. And certainly over the last couple of years, it has oscillated a lot. But over time, there's an average. And if you don't have growth in the earnings, you're not going to really have growth in the price of the stock. And so that's our focus at Baron Capital. I call it finding, durable growth, faster for longer, as well as businesses that will turn that top line growth into material free cash flow and earnings. And that's why I demonstrated it with this chart of, our select digital transformation leaders showing their growth and showing their free cash flow generation.
I'm going to turn to some questions, and one person asked us about your top 5 holdings, but I'm going to actually just touch on first. The first question I got is, I believe Microsoft is reporting today. Can you provide a couple of things you are zeroing in on, or you might affect the position size going forward? It's the largest holding in the fund. Maybe you can comment on Microsoft.
Yeah, again, in terms of when people should look at the portfolio, I've been very clear. We look at the portfolio in 2 different ways. The primary way is, of course, absolute. What's the position size of the given holdings? And those are going to affect the absolute returns that we're generating for our shareholders. And again, that is our priority. At the end of every quarter, of course, we're compared against an index. We've had years where we've done great against an index. Fortunately, 22 was not a good year. And so we're well aware of where we are, versus the index in terms of our sectors, our industries, and our individual stocks. So Microsoft is currently the biggest position in the portfolio, and it is not the largest overweight, because it is a very, very large position in the index. But we are very favorable on Microsoft. We think the secular growth trends, particularly around cloud, where they are one of the 2 top leaders, Amazon AWS and Microsoft Azure. I talk about in the quarterly letter, Morgan Stanley, who does very good CIO surveys, did a CIO survey of cloud computing and the winners and leaders. And the cloud computing trends are very, very positive long-term. And Microsoft always comes up as the leader, particularly when you're talking to enterprises, right? Startups may go more with AWS, but mature enterprises who have been built on Microsoft for 20, 25 years are moving a lot of workloads over to Microsoft. So honestly, the number one thing that we're focused on is cloud computing. Now, we know that Microsoft is facing headwinds because companies are doing what they call optimizing. They're trying to They rushed to spend a lot of money on cloud computing. They're now trying to optimize those workloads. We've seen this cycle happen over many, many years. And then once they've optimized, the economy gets better, they move along. I mean, I put the numbers in the core letter, but we're only in the 20s in terms of workloads moving to the cloud. And we think that number within 4 or 5 years will easily be 50. And long-term, it's probably gonna be 75 or 80% of workloads. The other thing that everyone's focused on with Microsoft right now is, of course, what's going on in the PC market, personal computers, including like things like a Surface or a laptop. And you had a real pull forward during the pandemic, and Microsoft has difficult compares there, but that's cyclical. PCs are not a high growth market. Microsoft is continuing to take market share with Windows by penetrating more consumers, but more importantly, what we think of as knowledge workers, and there are a billion of those. So Microsoft is getting growth among knowledge workers and then delivering and giving them more products, more applications, which are very attractive. And just one last point, when we talk to enterprises, right now, they're looking to consolidate their information technology spend with fewer and fewer vendors, the vendors that are platforms that offer attractive bundles. And Microsoft used to be a bundle of services that was, viewed as good enough. And all of our research today, as Microsoft has innovated very, very well, indicates that Microsoft is no longer good enough. It is what I call very good enough. Their products are very, very good, and their bundles are very attractive to enterprise customers right now. So our focus is much more on the long term. I don't dispute that the stock will probably move after market and tomorrow on just the near-term numbers of where Azure comes in, particularly, and what the kind of 1 quarter forward guidance will be.
Yeah. Okay. And someone commented about that the letter's not out, so they wanted to know more about the top 5 positions, Microsoft being number 1. I will tell the person that came in as anonymous. Actually, if you go to our website, our top 5, our top 10, and our holdings are updated about about 2 weeks into the quarter every quarter. So it is updated on the website, but maybe you can comment on the top 5 holdings.
Yeah, listen, I'm happy to give them. At the moment, the top 5 in the portfolio are Microsoft, Google, Amazon, NVIDIA, and Tesla. In terms of weights, it's a little bit different. You have companies like Gartner, very, very long-term holding written about in the quarterly letter. You have companies like CoStar Group, again, a 20, no exaggeration, 20 plus year holding in our portfolio. Those names are also in the top 5 of overweights. So sometimes the absolute and the overweights are different. When you compare against the Russell 3000 Growth Index, which is dominated, of course, by the large cap, unlike some of my colleagues that do smaller mid-cap portfolios, the large weights are very, very significant. So Microsoft, Google, and Amazon are significant weights in the index. So we look at our absolute positions, and we look at how much over or under are we in those names. And certainly, if you like a name, and I've been clear on Microsoft, if I owned 8% of that, it would be a big position in the fund, but we would be underweight Microsoft, which obviously doesn't make sense to us given our constructive view of that company long term, and certainly as one that we think will weather economic headwinds better than others.
There's a question. It has to do with do you anticipate, and I'm going to answer a little bit before I ask you to answer it. Do you anticipate the market testing its October lows? And if so, should we defer additional funding into opportunity fund until then, or begin dollar cost averaging? I'm going to actually go back to experience I just had. So at the end of the year, like everybody else, tries to find some tax losses. Mike, I know you took some tax losses in the fund and carried forwards. And I am a big proponent to dollar cost averaging, and I've been doing it, and I buy 3 times a month, and I own quite a bit of Barron funds. I actually went through my taxable accounts at the end of the year and couldn't find any losses, and it had to do with my dollar cost averaging strategy. So maybe you can comment on, do you think we're going to test the lows, or we're going to continue to or should I start dollar cost averaging? You know my answer, because I just kind of told you already.
In the direct answer on whether we will test the lows, I have no idea. I'm sorry, I have no idea. So I write about the backdrop that we're in today, and the dominance of macro. I've written in other quarterly letters, I called it a do-si-do, like a 2-step dance. I don't think I used that term this quarter, but the dances between rates, driven by inflation, of course, the Fed. Have we peaked in rates? Inflation's clearly coming down. How fast will it come down? When will the Fed pause? When will the Fed pivot? And then what I'll call, and I'm going to put the quotes on if people can see, the recession, because this is the most widely forecasted, predicted, talked about recession, given we're in a digital age, literally probably in human history, and therefore the impact that will have on numbers and on earnings, and the market keeps moving back and forth between those things. So we are now about to get earnings and probably forecasts. Some companies will forecast, calendar or 23. Some companies won't. So we will see. Wall Street has pulled down numbers significantly. Of course, we've done that in our own modeling. We've also run what I call scenario analyses, downside cases. I could talk about that. I mentioned the issues, right? The issues that we're facing, of course. Where will rates be? Where will numbers be? And truthfully, no one knows. And I follow a handful of what I'll call really smart and experienced economists or strategists. And I put this in the quarterly letter. The range of plausible outcomes on any of these issues, I'm not kidding, you could drive a truck through. So I say, you know what? We're not getting on that truck. We're not taking that ride. And we're not. So that's the backdrop. But again, we focus on what we can control. We can control our research, our analysis, keeping with our processes, our portfolio management decisions. And that's what we're trying to do. And I think I talked about it early on, the best balance, and it's never going to be perfect, of companies that will weather, potentially thrive in this economic downturn, because often when you go through a period like this, the strong get stronger, will come out of it very well and see accelerations in their business. They're now trading at multiples and levels where the upside downside risk reward is in our favor. And I'm quite confident in where returns will be. I'll say it slightly longer term. I truthfully don't know exactly what the next 6 months or year will be. But when I look out literally just 2 years, not saying 5 or 10, I feel very, very, very good. So I'm sorry to not tell you whether we've hit the bottom. I hope so. I just don't know.
A question came in about overlap. Do we monitor overlap? I know the research process that we have here at the firm is you talk to a lot of other portfolio managers and analysts, and this is a great idea for you. And maybe you may even talk to Jeff Coles, who runs our real estate fund. I just heard a great idea. You should take a look at this. Talk about overlap. Do we?
Yeah, so we monitor overlap. We cross-pollinate literally all the time. We just had a meeting yesterday where we're talking about all of our software investments with, multiple portfolio managers, and therefore what might be appropriate for, Cliff and David who run small cap, Andrew who runs, asset fund. Michael was there, on some Moran's funds. Of course, what I do with the Opportunity Fund. I'm also co-manager of Barron Technology Fund now. So we do cross-pollinate. We do monitor overlap. Probably the most significant overlap maybe between my strategy and Alex Szymanski's strategies. And for everyone listening to my strategy, I run my fund to do the best I can for my fund. I don't try to maximize or reduce overlap with any of my colleagues. So I do what I think is genuinely right. There'll be a period of times where there's a little bit more overlap and a period of times where there's different overlap, because when you think about it, there's a common research and we have some common views of some of these secular growth trends, but of course we have differences as well.
Okay. We have a question that came in. It was sent actually through email. It said, with the huge price drop in Tesla, not only last year, but especially in the fourth quarter, I'm not sure how much, if any, you have added to Tesla, but what are your thoughts about being bold and either doubling your position and going even bigger into Tesla? Maybe you can talk about Tesla. And I know you comment on Tesla quite a bit in your letter this quarter.
Yeah, I do comment on it. I urge everyone to read it. I understand how much Tesla is in, obviously, the public eye, and we've certainly been long-term shareholders on Tesla. We've been long-term positive on Tesla. I'm well aware, of Ron in the public media and on CNBC. I've always shared with you that my fund is, first invested in Tesla, I believe, in 2014. So, we're going on 9 years. We know this company really well. We look at it very, very differently than others do. I'd say one of the biggest focuses is on what we call, unit level economics. And for example, last year, Tesla was able to prove and deliver $15,000 of gross profit per vehicle across the Model 3 and Y lines. Now, with their price cuts, we do believe that will come down this year. But we don't believe it will come down as much as other people think, because we really understand the different factors that go into that. But I did add to Tesla during the fourth quarter, and I think I said it earlier in the call, Tesla is the 5th largest position. The stock has been incredibly volatile lately. If it had kept going down, I probably would have added more. The snapback when they lowered prices was very, very fast. But we have a material position in Tesla. They will be reporting earnings on Wednesday. And again, I have no idea how the stock market will react. I mean, if anyone wants to know, and I wrote about it in the Courier letter, we think the move that they made to lower price in the midst of potential demand issues around the macro was the right thing to do. A couple of reasons. Years ago, people worried about Tesla going bankrupt. They now have over $20 billion of cash on the balance sheet and effectively no recourse debt. They have some debt, but it's all secured by assets, whether it's solar assets or cars in their leasing fleet. Over the last 4 quarters, they generated $9 billion of free cash flow. $9 billion. I said at the peak they had $15,000 of gross profit per vehicle without credits. The entire automotive space is now facing some weakness. The legacy automakers are slowing down their push into EVs, and some of the EV startups are, having trouble scaling, having trouble delivering positive unit level economics. So this is the right time, I truly believe, for Tesla to put the pedal to the metal. And early indications are that demand has really, really picked up. And so we think that's the right thing to do. The other thing is, and Elon has talked about it publicly, once they get that fleet out there, of course, you take market share, you see your friend's car, so you have a viral effect of more Teslas being out there. But Elon also believes long-term, and we agree that there's opportunities to further monetize that fleet. Autopilot, which is their full self-driving or autonomous driving software, has low penetration. As that improves, more people will penetrate it. And today, you could subscribe to it. And the other thing is the long-term robo-taxi opportunity. The bigger your fleet is, the bigger that opportunity will be. I'm going to stop there. There's a lot more things I could say about Tesla if anyone wants to have a follow-up, but those are, a summary of some of the reasons why we did decide to add to our Tesla position in the fourth quarter.
Maybe you could comment, you talked about the EV market and other cars, maybe you can comment the other EV we do own is Rivian. You comment about Rivian.
Yeah, we own Rivian. We were private investors in Rivian, and therefore those shares were at attractive levels. Rivian candidly got hit by a little bit of a perfect storm. They went public and started ramping up the production at a time when inflation spiked for all things automotive. There were shortages of chips. Others were able to raise prices because they had less of a list of customers that have basically signed up. Rivian had something like 70,000 reservations. They tried to raise prices. We thought that was the wrong move. They reversed on that. So until they deliver on those old reservations at old pricing, they're literally going to lose money on every single car. They are burning cash right now. They're being very, very careful to try to get to, through 2025 without having to raise capital. I believe they will raise capital in 25. It'll depend on what's going on in the markets then, whether it be equity or certainly debt capital. So they're facing a tougher time. We did decrease our position in 2020 hindsight. The amount that we took in the IPO was frankly too much at too high of a level. So we definitely learned lessons, but we've decreased our position, took a tax loss in it, and some of those dollars did go into Tesla because we're more confident in Tesla right now.
Okay. I'm gonna we talked about this when we were setting up for the call, and somebody's asking a question, so I'm gonna make sure I ask it. And you've said it's one of the most interesting, most exciting innovations, technology innovations out there. You said it was this is something that's going to be absolutely incredible. It's a ChatGPT. Somebody said how it's going to affect Google, but I think it's going to affect a lot of other places other than Google itself.
Yeah, so ChatGPT is an application of what we call artificial intelligence. I think it's incredibly exciting. It has certainly captured people's attention, whether it's real use cases, and there are some that people are actually using it for real things, or just people playing around with it. It was the fastest digital application literally in history to go to 1 million users. I think it was within 5 days. We could check the actual timing on that. We certainly acknowledge there may be a little hype around ChatGPT, but AI is real. And we have been investing in AI for many, many years. ChatGPT is what is called a large language model. Most people know about AI from what they call recommender or recommendation systems. For example, the video that you're shown on YouTube Shorts, or your kids might be looking at a TikTok, or the song to listen to on a streaming movie server, music service, or what movie to watch, on Netflix. When you go to Amazon, they're going to surface up based on, using AI and learning from what you've done, what product you should have. All the emails you get from anybody that's trying to pitch you, a product, or to go back and buy more of their services, more of their products. All of that is based on artificial intelligence recommender systems. We think this stuff is real. We think it is probably the most significant, what I call, tectonic shift in, maybe in any industry, but certainly in the technology industry, and along the lines of what we've seen with cloud computing and mobile computing. So it's a big investment. There are going to be real world applications of this. In my quarterly letter, I joked that the quarterly letter was not written by ChatGPT, but a lot of people are using ChatGPT to write initial copy. It is being used to write initial code. Where it will get to, who knows? Schools, parents are already worried about, kids doing their homework or writing papers with ChatGPT. There's worried about, oh my God, am I going to keep my job if ChatGPT can do an initial draft of something? I do believe AI will significantly improve the efficiency of human workers. It will allow us to take advantage and harness all the data out there to make better business decisions and maybe consumer decisions. But it will also create an enormous amount of jobs as well. So we're very positive on AI investments. Not only the Googles, Microsofts, or all, I didn't even mention it. Microsoft's investor in ChatGPT, and ChatGPT runs on the Microsoft Azure service, and certainly it's a big driver of semiconductors and investments in NVIDIA, which we got a long-term investment, or things like AMD. I'll stop there, but it's very exciting. It's a tectonic shift. I mentioned it because it's captured people's attention. We understand the role. We think there'll be many, many more large language models in addition to ChatGPT, but I just wanted to highlight it because it's caught people's attention.
I'm gonna a couple of holdings. Someone was asking about a few holdings. I'll rattle them off. They were down significantly last year. What are your thoughts about the company moving forward? Intuit Surgical, Zoom Info, and CrowdStrike.
Listen, almost every stock was down. I had a few in my portfolio. Most stocks were down on multiple contraction. There's certainly economic headwinds. Intuitive, frankly, I think there's been the least amount of change. Kind of the cyclical impact on them was basically getting hospitals open and getting patients to have procedures, where they were competing at different times with people with pandemic illnesses, related illnesses. And so there's nothing that I see that really challenges the long-term for Intuitive Surgical and, the shift from, human surgeries to more robotic assisted surgeries. So they report tonight, so we'll see more tonight, but the long-term hasn't really changed. And the cyclical of, reopening hospitals and how many beds can you have, that's real short-term. We're going to get through that. The other two, CrowdStrike and Zoom Info, software companies that certainly had multiple pullbacks. Both companies, I would say, we feel very solidly about the long-term secular trends. For CrowdStrike, certainly cybersecurity, the number one being endpoint, securing your phone or your computer. Zoom Info is using data and other applications to help businesses, B2B, business to business, go out and sell, what they call go to market. We candidly feel that ZI is a little bit more challenged in the macro right now because we see it in the media and we hear it that companies are slowing their build of their sales forces. You've seen some layoffs in different places. They have a big chunk of their business against the software opportunity, and the software market has suffered a little bit. So there's definitely a macro there. We frankly have decreased that position size a little bit. CrowdStrike, we talked about in the quarterly letter, highlighted because it was a detractor. I mean, it grew very, very fast last year. It's going to be a 50% grower in 2022. They gave initial guidance for 23, and that's still in the 30% level. So the secular trends are clearly very, very strong. But coming to the year, we would have thought that would have been higher without the macro that we're in right now. And so they talked about the weakness, and that spooked investors, and that pulled back. frankly, we're holding right now, holding at a little bit lower level with the stock price down. We're frankly waiting to just get a little bit more information, and we're looking forward to them reporting earnings and giving formal guidance on 2023. But we've been definitely active in software, and in the quarterly letter I did put some of the names that we did add to during the period. So we tried to be selective in the way that I discussed earlier, and I'll highlight just a few names, Bill, if anyone wants to have a follow up. We added to Ceridian, established a position company called GitLab, which helps developers. Added to Datadog, Guidewire, HubSpot, Cloudflare, and Workday during the quarter. So we were definitely active in the ones that kind of had the balance that I articulated earlier that we were looking for.
Okay. Someone asked a question about Ring Central, which is no longer a position, correct? And they asked
Correct.
about it, so you sold out of it. Is that when you trimming the herd, one of them you got rid of?
Yes, early in the year we sold out of it. There was definitely a slowdown in the adoption of essentially cloud communications. There was more competition, and I think in some ways, I'll just admit it, we were wrong a little bit on the secular and sustainable competitive advantage that company had. And when our research indicates that, and sometimes it's due to a mistake, we sold out. The stock has come back significantly. There's some talk about maybe PE interest in it. Every stock that we once owned, we still watch. We have not come back in Ring Central yet, but candidly, that was the change in the cloud communication market and the competitive environment as it kind of developed, challenged our long-term view. So I'll acknowledge that.
Somebody, you mentioned your co-portfolio manager technology fund. Somebody wanted to say, what's the difference between the Barron Opportunity Fund and the Barron Technology Fund?
Yeah, the Barron Technology Fund is just more focused on technology. The lion's share, 60-70% of that portfolio is information technology. The areas outside of information technology that we own would be digital media, e-commerce. We have a little bit of electric cars there, but for example, there's no healthcare in there. There is no industrials in there. So it's definitely I think about it as a concentrated subset of what I do with the Opportunity Fund. Again, focused on technology. From a marketing, or sales perspective, Opportunity Fund, which certainly we invest in technology trends that I've talked about for years, but it's never been considered by any third party, such as Morningstar, as a tech fund. As Bill articulated early in the call, it's viewed as a large cap fund by Morningstar. Others view it as an all cap fund, which it technically is by prospectus. And a lot of the buyers out there in the market, whether it's self-directed investors or certainly professional investors, when they're looking for something, they're looking for a bucket. And we thought, given the history we had investing in technology, certainly with Opportunity Fund, with the work that Ashim did, he's my co-manager, certainly what Alex has done with Global Advantage and Fifth Avenue, we thought, at Barron, we made a decision. It made sense to have, a core technology fund that fit right in the bucket.
So we got a question, and it has to do with, I actually pointed out, and I love the comment. David Schneider actually made a comment. Linda wrote it in a letter. She talked about it. It was talking about our long-term focus. And in this kind of environment, you need to put Barron goggles on and really focus long-term. So this gentleman asked, he said, Mike's references is his conviction to be better 2 years. Certainly it's going to be, your convictions 5 years, 10 years and beyond. Does Mike see outperformance through the end of the decade, as we saw after 2008, 2009, we took off a leader, for the decade of 2010, the stock market did very well and funded.
And listen, I'll answer that totally straight. I'll give it to you totally straight. What I'm saying about the next year, listen, I've learned from all the years that I've been in. I've certainly worked for Ron Barron for 20 something years. He's written about it for 40. It's really hard to call the immediate future. So we started out well so far this year. I hope it continues. I think stocks got to a very attractive level. Growth investing, excuse me, tech investments really took a beating. When we got to the end of the year, I felt very positive longer term. And by that, it was simply for lack of anything else, I said 2 years because it's almost impossible to call the next year. And when we talk about it internally, and I'm going to talk about it with you, when we think about the way the world is changing, we think about the secular growth trends, that I discuss on these calls, webinars, and my quarterly letters that we've researched for years. They're all intact. Nothing has really changed in there. We're just facing an economic headwind. Those companies will push through. Even, for example, as weak as CrowdStrike has been as a stock, they went from 50% growth and they're guiding to 30 to 35% growth. Maybe they'll change that a little bit. So this is way faster than economic growth will be. So these trends are still powerful. At the price levels that we are at today, when I look at just literally 1-2 years out, it's very attractive. Will it be realized in 1 year? Of course, I don't know that. But when I look at 2 or longer, I'm quite confident. I'm 56 years old. So I always think about, all right, believe me, I'm making no retirement announcement. I may do this, way beyond, 65. But if I think about the next 9 years of my life, I knew I had to get through 22. The next, as far as I can see, looks very positive. I've said this before. Most investors, certainly investors at Baron Capital, we're not traders, we're long-term investors. I'm trying to do this on the screen. We'd love it if it was Goldilocks market. They went up nice and smoothie, up and to the right. It just doesn't work out that way. It's the market, because the markets are human beings. And so we go up, we go down, we go up, we go down. We try to plot, with our investing mindset and with our literal investments in our portfolio, kind of that line that we'll go through. And long-term, that's what we're trying to deliver for our investors. And yeah, looking out at the rest of this decade from where we're sitting now in January 23, I'm very optimistic.
So like in the same, you talked about being a Baron investor. When I joined the firm in 2009, I sat down with yourself, sat down with every portfolio manager, and everybody said the same thing. The way we invest in Baron is this way, and it all goes back to long term. So how much pressure? Because I know you're competitive, right? Yourself, and I know you invest at every PM invest. It's not we tell you, hey, every PM has to have minimum $1 million in their own funds. So how much pressure do you feel on the short term from the firm, from yourself? Because it's got to drive you nuts at times. Maybe you can comment on that. Maybe comment on it.
I mean, I'll be honest and candid with everybody. Most of the pressure comes from myself. As Bill knows, I'm a very, very competitive person. I grew up playing sports and competing there. Now I compete, in the stock market, in investing. And that is, the two keys to that are, basically, our brains, but not just our brains, because collective brains, the group that I have, and following the right process. And of course, it's hard work. And I joked about that in my quarterly letter. Maybe they'll pull that out. But when I played college basketball, we had hard work literally written on the back of our practice shorts. And that was our break the huddle cheer. So I've always known that there's no substitute for hard work. So we're trying to do the work, but I'm competitive. When I look back at 22, coming into the year, I was well aware of where stock prices were. I was certainly well aware of where interest rates were. And, we didn't expect what would happen this year. We didn't predict it, but we knew that they were not going to remain at a zero level. We knew that multiples were too high. We certainly thought about, the need to protect a little bit on the downside, but you can never time those things perfectly. We definitely made some moves in the portfolio. In all candor, again, some stocks that we thought that would be more ballast stocks, the Googles of the world, the Microsofts of the world, didn't hold up as well. If I look back with 22 hindsight, we should have done more. We just should have done more of protecting. But now we're in a different market. So those are lessons that I talk about all the time. I've definitely done sit downs with my whole team, and I've done it by myself, and it's all written down. The lessons of 2022, they're in the Lippert file cabinet. Probably in the next decade, there'll be another period of time when we're in a frothy market, and we may have to pull those lessons out. And I want to be clear, like markets go, as I said, up and down. Some of these lessons will not be with normal up and downs. They'll be the next time if we're in an extreme. We went through an extreme. I don't know, and there's no prediction on when, again, we'll be in an extreme. I do believe we got to the point where we're an extreme on the low side, which is why I'm optimistic about the long period. But, I'm very competitive. But I wrote about in the quarterly letter, like, We're not trying to figure out the market. We're not trying to call the bottom. I'm not trying to call economics. We're literally trying to run our play. And I'm trying to make the portfolio the very best that it can be for our investors, for the consistent with the Barron, mindset, philosophy, what we deliver in long-term investing. So that's what I'm trying to do this year, not trying to game anything and produce a quarter's worth of results or a year's worth of results, because that would totally be changing our stripes. And I think that would be a mistake. So that's not what I'm doing. I definitely learned lessons from last year. Some of them can be applied to our current research and analysis, and those we're doing. And the ones that you put in that file cabinet, they're there for the next time we may be in extreme frothy markets.
Yeah, I think I got every question you were asked. I'm going to ask one other question, and Ron, I just got back from the Barron's Top 100 advisor meeting, and Ron made a comment, and I love the comment because we get a lot of questions, especially about Tesla in the field, and I say to everybody, we do our own research. Talk about the value of doing your own research, not listening, because I get a lot of, oh, this person said this, and that's, and this analyst said this, and I know we don't take that. We do our own research. We break it down, breaking the company down.
That's a great question, and Ron said it for 40 years. I mean, it's the key to what we do. I mean, and as I talked about in dealing with an environment like that, I write in my quarterly letter about, and it's a life lesson that I've learned. I call it focus on what you can control. I can't control the market. I can't control the Fed. I can't control the economy, the recession. Even, with Tesla, I can't control what Elon Musk is going to say on Twitter, for example. I and my team, and by that I mean team within Barron, the Barron team, we can control our research. We can control our analyses of all different things. And there's a lot of detail on that, some of it's in the quarterly letter. We can control the portfolio management decisions that we make. So that's what we do. And what I think differentiates Barron are two things. Number one is research, the team that we have, our internal research. But number two, which also distinguishes the first, is duration or time as long-term investors. How it distinguishes the first? Yes, of course, today I talked about we're trying to find companies that will be most resilient against the economic headwinds, but we're much more focused on, what I call faster for longer. Companies that have durable growth, sustainable competitive advantages, will turn that into significant, free cash flow and earnings. In our research, where everyone else is, not everyone, but so much of the market is focused on what's going to happen now, what's going to happen now. People are debating with Microsoft reporting tonight, whether the Azure will be 1 point higher or 1 point lower. If I said that to Ron Barron, he would say, who cares? And I'm like, well, the market will care tomorrow, but for the long-term value of that business, it doesn't matter. When we think about Tesla, for example, the long-term investment we've had in Tesla, there were people that thought this company was going to go bankrupt years ago. And we're like, nope, the unit level economics, which we did a lot of work, check out, that means they're going to generate significant free cash flow. I told you, trailing 12 months, it generated $9 billion of free cash flow. No one else thought that. I have friends that worked for Chanos, one of the big short sellers. And I talked to them about Tesla. We would debate it all the time. And I'm like, have you ever visited Tesla? Have you talked to Elon? Have you talked to the team? Have you gone to Fremont? Have you gone to, now Texas? They never did any of that. I'm like, how can you make a big short case if you've never done that work? They said they thought that research, visits like that would bias them. But we have a completely different view. What do we want to have in our research? We're seeking to have a knowledge or insight advantage against other investors, against other traders, that is based on the hard work that we do in our research. Again, a lot of detail, which I'm more than happy, head of tech research, I can talk about, but it's also about the difference in the perspective, not a focus on just current. We're focused on current, but a real focus on what can this company be? Size of the company, the business model, can it generate cash and earnings? You've heard me cite this, Warren Buffett's, Benjamin Graham, short-term market is a voting machine, long-term weighing machine. We're the weighing machine guys. How big will that company be, and what will that weight of the free cash flow and earnings be on that scale in the future? If we get that right, rather than the multiple today, will the stock price go down 5 or 10% on earnings? If we get that right, we will get our investments right. And I've done it now for 20 years at Barron Capital. And when you look at our best investments, it's the one that grew faster for longer. Why has CoStar been a 20-year investment? Why has Gartner been now a 15, which I talked about? Again, not absolute top 5, but relative top 5, because they've grown faster for longer. They've done things that no one thought. They had second acts, third acts, expanded their addressable markets. Maybe I'm a little excited, Bill, but that's what we do that's what we do at the firm, and that's what we're doing right now in all of our work, and that's what we're trying to get right.
It's interesting. I use the comment all the time. It's when you hold these Gartner. People ask, and I go, our team has spoken to Gartner's team over 100 times. It's not. They look at our low turnover and they say, well, what are you doing? You have a 31% turnover for a high growth portfolio, whereas I think the normal turnover for those kind of portfolios are probably north of 200 at times, right? It's doing the research, it's keeping up with it, it's continuously talking, and that's what we try to put out in the field to illustrate what we do differently at Barron. I think it really works.
Again, we try to know our companies better, and we try to know them again differently, right? What our focus is versus most of the market today, dominated by hedge funds and other short-term traders. It is what it is, because I've been on the buy side, for 20 years. I have friends all over. I know how they think about it versus how we think about it. And so sometimes our differentiation, in a year like last year, we're not whipping it around, and maybe we didn't protect as well, and certainly have some learnings from that. But our differentiation is certainly our research and our duration time, long-term investment.
And a great long-term performance is what really is the key. Which goes back to the question, should I dollar cost average or should I wait? Well, dollar cost average, keep on putting it in. Let's end there. If you have any comments you want to end with, I thought it was a great place to end. But let's end there. I want to thank you very, very much. I don't know if you want to add any other comments you want to add.
No, I mean, I don't. And people who know me, and people who will do follow-up calls with me, I'm genuine. I'm pretty much a straight shooter. I'm not a poker player. My wife kind of laughs at me about that. And if you saw the excitement at the end of the call, it's not feign. I don't even know how to feign. I'm not an actor. Like, that is genuinely what I believe in. I've been at this firm now, I don't know, something like 21 years. I'm here for the rest of my investment career. We're very lucky to be at a firm like this. I find what we do incredibly intellectually challenging. I find it rewarding to think about where the world is going. And certainly, we're competitive. We had a bad year in 2022. We're all in terms of our work, sticking with our process to try to produce, great results for our shareholders going forward.
Well, thank you very much. I got to all the questions. If you have any additional questions, please don't hesitate. Someone actually just threw one up there. See if it's something we haven't answered already. The quarterly letter. The letter will be out. The question that was asked was about the letters being out. The letters are coming out. They're going through the editing and compliance process right now. So they're all going to hit the website first. Then we'll have them out on the quarterly report for everybody all in one jump. So thank you very much, Mike, for being with us, answering the questions. I want to thank you for your comments. Always candid and always great. There'll be some disclosure that's come up, and most importantly, I wanted to thank everybody who's on the call for the support of Barron Funds. Thank you for your continued support. This concludes our webinar today.